Hey everyone, this is Crypto Gordon Freeman, and you're listening to the Club 21M podcast. So this is the 9th episode of the Club 21M podcast, and today my topic is inflation, understanding inflation and defining inflation, and looking at that from the perspective of cryptocurrencies. And then Gordon draws a very clever metaphor of understanding inflation and the actual impact that it has on society. And I think even more importantly, trying to get to the truth of how severe inflation may be or may have become. As we can all understand and observe, unless we choose not to be aware of things, our governments are not necessarily very honest with us about how money is going. In the U.S. and in many other countries, most other countries at this point, we have a print at will, backed by nothing type of fiat scenario, which the history of is very interesting how we've gotten here. Not necessarily intentionally planned the way that it has gone down, but when there is an imbalance in the structure of central banks and the issuance of funds, the amount of money that is circulating, the amount of money that a government wishes to raise or secure for budgeting, when there's an imbalance or irregularity in these things, say there was a pandemic or something along those lines, then they always have the option of printing more money. This is something that's kind of easy. You know, if you own the money printer, then money printer go brr is kind of an easy decision to make, but it is known on all levels that it comes with consequences. So we're going to look at what those consequences are in the definition of inflation. So before I go into defining what inflation is, I want to offer to you a metaphor that dawned on me while I was thinking about this episode. It occurred to me that black holes were a perfect analogy for, well, a lot of different things, but in this case, inflation. Because so many different things in economics, and especially in macro, where you're looking at entire complex systems and the history that surrounds them, there are many things that remain theoretical because of the complex nature of systems. You know, systems involve so many different things, the input and output of so many different factors and variables. So it's easy to look at something and say that the reason that prices are doing what they are, or the reason that spending is up or spending is down, or jobs are up or jobs are down, you can always pin the reasoning on so many different things that people develop ideologies and constructs that help them to determine what they think the reason is. And in all truth, we might find ourselves living within the constraints, the confinement of a philosophy instead of necessarily looking for the truth. So oftentimes the best way to figure out what the real reasons behind something are to look at the data surrounding it. And I thought that a black hole made for a wonderful analogy or a wonderful metaphor for such a thing. It's a symbol of inflation, where at the end of the day, we can look at the natural events, what we believe about something like a black hole. I think that we've gathered enough evidence to find that the amazing imaginations and ponderings of brilliant scientists of the past have been playing out in reality in a lot of different fields, and quantum fields and black holes and things of this nature. So with the black hole, you know, we're talking about a force that is so powerful that it basically sucks everything into it. Essentially, the idea is nothing survives a black hole, and it's almost the opposite idea in many ways of the Big Bang. And I think in a lot of ways, we will never fully grasp what kind of natural force is taking place. But we have come to understand things, unless you're a flat earther, about gravity and the rotation of planets and suns and moons and all these different things. With the black hole, you can't look at it and say, these are the visual properties of it, because within its own mass, technically there's nothing to see or hear, and we can only kind of look at the events surrounding it, its effect on other things. And I think inflation is very similar for a very simple reason, and that is that a dollar equals a dollar, a euro equals a euro, and go around the world in whatever the legal denomination for that country. One Doge equals one Doge. So inflation isn't going to tell you your dollar now equals 90 cents or 80 cents or 70, 60, 50, 40 cents. But over the decades, we certainly see that the value of fiat, something that is issued by the state, that is guaranteed by the state, and therefore our confidence is only in it because of the state, these monies are backed by confidence instead of a pegged resource of some sort. We don't use a gold standard, and there are a lot of different interesting historical reasons for that. So the black hole as a metaphor, it's such an interesting parallel because it's this pressurized, massive compression of mass and weight, and this intensifying of gravity, and the idea that anything that comes within its reach is helpless to evade the effects of. And yet you can't look right at a black hole and say exactly what it looks like or what its own properties are. You can look at the properties of what it does to anything that comes within proximity or enters it. And then from there, it's our imagination as to what we think happens from there. So science has been able to look at the evidence of things like stars that take a very specific path and then move around something as if it's there to continue on that path. Other things that seem to be there and then are not. There have been recent developments where they believe that they've discovered a black hole, and they've gotten visual data that they can take that different data together and essentially construct a picture of what they've seen. It's not a literal, click, I took a photograph of a black hole, but, teams of scientists that independently take their data about what they believe it is that they are measuring and take those visual cues and put it together, and they believe they've got essentially a picture of the light and the energy and the massive chemical reactions surrounding a black hole. So now I will go into defining inflation in the different versions, the different ways that it can occur. So I always defer to Investopedia.com. They are not a sponsor in any way, shape, or form, although if Gordon was smart, he'd probably pursue that. Because I just love the way that they break down things in a very straightforward manner. Excellent stuff. So what is inflation according to Investopedia? Inflation is the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. So we could always look at temporary bubbles or temporary changes, temporary fluctuations in the value of things and assume that they're inflation when perchance they're not. For an example, if there was a pandemic and it causes problems in commerce, let's say, or if we had something, let's say, like a pandemic that caused a certain industry to run behind on supply, or there was a supply chain problem, shipping goods became a problem, something slowed something down, and it was a very needed, scarce, suddenly scarce item. Let's say lumber, for instance, and the price of lumber goes shooting up. That may not necessarily reflect on the value of the currency having gone down. But when we look at a range of goods, a range of things like food supplies and lots of other things, let's say the conditions of the pandemic are no longer bottlenecking specific areas of industry, numbers of workers or number of trucks on the road, these types of things. Natural disasters aren't affecting those types of things. And we still see a price hike happening. That price hike is going to be the place where you see the signs of something else devaluing. So that's what we're looking at for inflation. So deflation would be the opposite of that when we see the buying power of money going up. And I doubt that we'll see that in our lifetime, but that is something that we're very likely to see, how cryptocurrencies might be one of those places where you see the value go up as the price of the dollar in other legal tender sovereign currencies go down. So inflation is the rate at which the value of a currency is falling, and consequently the general level of prices for goods and services is rising. Inflation is sometimes classified into three types: demand pull inflation, cost push inflation, and built-in inflation. Now, something that I think is very interesting about this too is that we can look at the different schools of thought about economics and how not only inflation is defined, but cause and effect, in that inflation often is the result of reacting to monetary conditions in an abstract way that is a school of thought versus just hard set economics. So we have Austrian economics, we have other schools of thought, and many times the governments, as they lean more and more towards socialist ideologies, you'll see more and more of the thinking that spending should be intentionally injected into specific sectors that are suffering, instead of looking at the symptoms of the problem, what is causing those sectors to suffer. And high taxation is usually one of those key factors. So inflation is sometimes classified into those three types: demand pull, cost push, and built-in. The most commonly used inflation indexes are the Consumer Price Index, the CPI, and the Wholesale Price Index, the Wholesale Price Index, WPI. Inflation can be viewed positively or negatively depending on the individual viewpoint and rate of exchange. That's a tough pill to swallow. I think inflation bad. Those with tangible assets like property or stocked commodities may like to see some inflation as that raises the value of their assets. Okay, so think about trading and imagine a cryptocurrency chart for Bitcoin and the USD. If $1 equals $1 and there's inflation going on, we might see something similar to the S&P or other stock categories with Bitcoin, where if the dollar is going down in value, we might see the value of Bitcoin going up. If that is being caused by inflation, then you could say people with a lot of Bitcoin like to see the dollar getting devalued. The problem is everybody still needs to be liquid in some form of currency in order to buy things. And if, for instance, somebody wanted to buy things in Bitcoin, then their Bitcoin may be going up, if it is inflation related, at exactly the same amount as the price of the goods that they would need to buy. So even though it feels like Bitcoin is going up, let's say it went up 10% at the same time that the price of gas goes up 10%, then you may be getting the same amount of something that you had before. There are other ways to package inflation by offering the same goods at the same price and offering less of them, which essentially is just tweaking different parameters to get the same outcome. Understanding inflation. While it is easy to measure the price changes of individual products over time, human needs extend much beyond one or two such products. Individuals need a big and diversified set of products as well as a host of services for living a comfortable life. They include commodities like food, grains, metal, fuel, utilities like electricity and transportation, and services like healthcare, entertainment, and labor. Inflation aims to measure the overall impact of price changes for a diversified set of products and services, and allows for a single value representation of the increase in the price level of goods and services in an economy over a period of time. So you might say inflation has hit 5% because they're looking at the price of food and grains, coffee, gas, items that everybody needs, clothing. So we can look at that as the general cost of living and compare that. And it depends on whether we're looking at longer trends or shorter trends. 1 year, 10 years, 20 years. The longest trend always tends to look very bleak because we don't really have an example on planet Earth of a deflation taking place. So central banks are essentially the way that money flow is handled with this stuff. Money supply is handled with this stuff. So they will manage the supply of money and credit to keep inflation within what they see as permissible limits. And that's one of the problems, is that none of this is at a permissible level at this point, but they're still the ones that make that decision for us. So what are some of the causes of inflation? An increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. Now, strangely enough, there are economists that will tell you that money supply is not directly related to inflation. That's a little bit whack. So money supply can be increased by the monetary authorities either by printing and giving away more money to the individuals, by legally devaluing the legal tender currency, more by loaning new money into existence as reserve account credits through the banking system, by purchasing government bonds from banks on the secondary market. Now, this is not going to be a show about how that entire circular activity takes place. In all such cases of money supply increase, the money loses its purchasing power. The mechanisms of how this drives inflation can be classified into three types: demand pull, cost push, and built-in. So let's talk about these three types real quick. Demand pull effect. Demand pull inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. With more money available to individuals, positive consumer sentiment leads to higher spending, and this increased demand pulls prices higher. It creates a demand-supply gap with higher demand and less flexible supply, which results in higher prices. Bottom line of these, you'll hear, at least from Gordon's perspective, manipulation. This is manipulation of markets, manipulation of socioeconomic activity. Even the most knowledgeable person will eventually fold to their human nature when it comes to how they spend. Cost push effect. Cost push inflation is a result of the increase in prices working through the production process inputs. When additions to the supply of money and credit are channeled into a commodity or other asset, markets, and especially when this is accompanied by a negative economic shock to the supply of key commodities, costs for all kinds of intermediate goods rise. These developments lead to higher costs for the finished product or service and work their way into rising customer prices. For instance, when the expansion of the money supply creates a speculative boom in oil prices, the cost of energy for all sorts of uses can rise and contribute to rising consumer prices, which is reflected in various measures of inflation. So coming back to the lumber example, you might look at this and say the cost of contracting has gone up. The cost to build a house goes up because the cost of lumber goes up because the supply of lumber is being squeezed by the inability to get wood to Home Depot, for example. Built-in inflation is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. As the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs or wages to maintain their standard of living. Their increased wages result in higher cost of goods and services. And this wage price spiral continues as one factor induces the other and vice versa. So I don't feel that in order to understand inflation for the purposes of this podcast, we need to go deeper into consumer price index, wholesale price index, these different things. Learn it on your own. It is interesting stuff and it is all involved. But for the purposes of this, I want to focus on the impact of inflation and how you can focus on preparing for your future and your economic goals, factoring in the likely more exponential rise in inflation as opposed to a linear rise in inflation due to the type of economic powers we have in place. So as we look at the different ways that inflation can be defined, the different ways that one could explain its existence, I'd like to parse this information in two different categories: naturally occurring and manipulated. And to say manipulated, a lot of people will think that that is an accusation. And it's not really. A huge amount of the economics being practiced by our global governments would proudly state how they are trying to control markets and use the control of the flow of money to encourage job creation, to open up new markets, to prevent negative events from happening, and to encourage good events. Others would say that the government should not be the ones to manipulate what's happening with the financial system, that they should step back and allow what happens to happen. I think there are good arguments on both sides of it, but I don't want this to be a lesson about all these things. It is as it directly relates to cryptocurrency. So I want to, kind of define the beast in order to define things that help to tame the beast. So if we look at the idea that, let's just say we're talking about the dollar. If $1 equals $1, and we can't define how much that dollar is depreciating by that actual number, then we have to look at it by buying power. And in one camp, we have those who would want to intentionally inject power into the economy by stimulating growth, stimulating jobs, stimulating buying. You can do this through lots of different types of incentives. But when we look at the real data and the reason behind certain things, at the end of the day, the only way not to be at least partly responsible for inflation is to not keep printing more money. And the dilution of an item automatically puts value pressure on those who have it. A lot of people would think that the only two elements that really matter to them are their paycheck and how much it costs for them to live. And that's kind of, in many ways, missing the point. So if we look at just what somebody earns and their buying power, what they can get with that, and their wage doesn't change, then they will see the problems of inflation if everything around them that they need starts to become too expensive for them. And you have often a reactionary process of wages going up to counteract the issues from inflation. But the problem is that it's not just the elements of greed that cause the inflation to happen. When there's an actual shortage of certain things that society needs, or when there's an actual spending problem on the side of the government, which is usually the case, people in power tend to not vote against things that give them more power. Those who can control the money printer can control how much they're spending on things they want to spend on, and oftentimes even give themselves a raise while they're at it. So it's not just the idea that if the trajectory is wrong, we can just print more money. A lot of the problem is that they can print more money and approve more money to be printed for specific things. And because it'll never quite be enough, the printing of money almost always goes hand in hand with higher taxation. We want more things, we have more need, there's more crisis, we're going to have to squeeze the rich more. And so I don't think that people who are not so locked into their ideology that they're unwilling to admit the truth can look and see that that's the world that we live in, and it's a problem. And people who love freedom and don't want to be just told everything that they are supposed to do with their lives from the government, who can arbitrarily decide new rules at any given time, we'll see that the goal of, once you know your enemy, inflation, what do you do about it? And so I would say, once again, first of all, we look at cause and effect, and a lot of times we are told that there are problems, therefore we have to do these things. And I would argue that often what we have is a naturally occurring result from the wrong behavior, that we're getting inflation because they're doing the wrong things. And that if a lot of those things were reeled in, we'd find that very little changed in our actual lives when their spending dropped by the hundreds of billions of dollars. And we simply did with less of the garbage and the red tape and the greed and the bloated governments. So how does this pertain to crypto and black holes? Okay, so crypto and inflation, but the black hole analogy. If we look at anything that a cryptocurrency can be pegged to, then we look at anything that can be traded against something else. And one of the real issues is what kind of risks are worth taking in crypto based on the value of the item. So all day, every day, and until regulators just crush the market and scare things into being different, we see in cryptocurrency that there are coins that come along that are worth a fraction of a fraction of a fraction of a penny that suddenly gain momentum and have volume and liquidity that can go up 10%, 200%, 500%. And once the hype is over, the pump is done, they can drop down into the abyss. We may never actually see any kind of pump happen with them again. But there's always a new fool to come along and believe the hype around something. We heard news about this, or this is going to be the big next yada yada and all these different things. Well, it's true that you can get lucky by chasing one thing after another. And you can even sign up for groups that'll tell you when these things are incoming so that you can jump in for the seconds that'll make you mad, crazy gains. The problem is that with much potential gain comes much higher risk. You're talking about assets that have really and truly no provable value over time. The real value in them may be that for 7 seconds, you could make a killing on them. And the risk being that don't spend a single penny on them, pardon my comparison to what they're actually worth, don't spend a dime on them that you can't afford to lose, because they come down much quicker than they go up. And they were not up because of any practical market value that they represent. So then, if you're looking at what kind of things can I do to outpace the losses that I'm experiencing just by working a job and everything becoming more expensive around me, where I am the star that is near a black hole, and I know that inflation is eventually going to suck this stuff in. Is there anything that I can keep outside of that boundary that will continue to earn more than the exponential loss that is taking place? And this is where I think, if you love them or hate them, with or against people like Michael Saylor, they are incredibly smart people who are doing with their own business, putting their own value on the line to buy into something like Bitcoin. The quality of the asset matters. And there are plenty of reasons that Bitcoin could have failed. Everything that has really become a long-term benefit has proven to be a benefit. Could have been the thing that proved it wasn't worth what we all hoped it was. The fact that we don't have any real hard evidence proof of who created it could have been the thing that made people say, okay, this is really cool that this works, but somebody that we actually know and trust needs to make one of these things so that we know what's going to happen with it, can hold somebody accountable. The fact that it is decentralized and requires people being in a mutual agreement about any changes or upgrades could have been just as much a negative as it is a positive. The fact of the matter is that is turned out to be one of the things that helps to make Bitcoin resilient. Litecoin, the early narrative of it being silver to Bitcoin's gold, could have worked for it for a given time and then petered out as this huge influx of new coins came along with Ethereum and the ERC20 platform especially. These types of things could have made Litecoin so irrelevant that it wasn't able to kind of hang out as the little brother to Bitcoin. But the fact of the matter is that those early strengths have proven a third thing, which is that it is actually a strength to see longevity. The longer that something has been able to survive at market, the more validity it has been given. So those are actual legitimate values that people hold. So to understand a little bit about the inflation and the mystique that surrounds it, when there are so many different things that factor into why money is doing what it's doing, why the purchasing power is going down instead of staying stable, the true nature of inflation without manipulation is usually going to come from a chain of events. One thing that affects another, affects another, affects another. Supply chain, political turmoil, changes in social attitudes. People start caring more about certain types of products or certain types of living that moves people out of certain markets into other markets. An example would be, of course, it's not really having the effect that this example gives, but like the tiny house movement. People who have kind of bought into an idea that they don't want to be tied down by their belongings. They don't want what they own to own them. And so they want to live a small, efficient lifestyle and embrace the experiences of life over things. And of course, there could be a balance between those two things, but that could be something that took us entirely from the 80s or 90s swing from McMansions and people wanting to live the millionaire, multimillionaire lifestyle within their goals, their dreams of a budget. You had people that were leaning towards these Insta mansions that were growing up all over the place. And so you can have things that are reactionary over different swings of time. Tiny house movement could have had a huge impact on being able to sell traditional houses in traditional neighborhoods. Governments have a plan for moving people more into tightly centralized areas, into the big cities where there's public transit and all these different things. And AI and other technologies are eventually going to move us away from the idea of living in the spread out, wonderful landscapes of rural suburban areas into very small pieces of real estate in highly controlled areas of society. And people would have poo-pooed that this was even happening before 2020. I think people are catching on to the fact that there is a desire to control society in this way. And maybe it's not just those crazy Chinese doing this kind of thing. So how do you define what's happening and how do you combat it? So defining of it, first of all, there's the categories of naturally occurring and those that are manipulated, and cause and effect. And I think that those are the main things that I hope that you'll take away as you think about these things and what you are doing with your cryptocurrency plan. What is your plan for buying and holding, or dollar cost averaging, or investing, trading, whatever it is that you're doing? Have a purpose in mind, and keep in mind that that black hole, we're all just far enough away from it that there is still some kind of semblance of society going on. You can still buy things and sell things, and you're still alive, and a lot of people still own their property if they owned it. A lot of people can still afford to rent that were able to rent last year. But it's getting tougher, and most of us are sensing that it's getting tougher. Even remote work is getting to where you have to do a lot more of it to be able to earn enough to pay for the same things. So pay attention in your own way. Don't just listen to what the experts tell you is the reason that the economy is doing certain things. Consider it on your own whether money is being printed because of other issues that have taken place, and therefore it's necessary to counteract certain things, or whether the money printing is the very problem that is causing the other things to happen. When something like a decision to stop drilling for oil in a certain place means that a certain part of a supply chain is different than what it could be, not whether you think it's the right thing or wrong thing, but will that directly impact the prices that you can get from one source as opposed to another, and how much is actually naturally available at that time? Well, I think most people would understand that if there was less supply available of oil, that they may pay more at the gas pump. The question would be, did that have to happen? Was it a good thing for it to happen? And that's where we get into the circular reasoning of economics. I think oftentimes the philosophy behind why things happen the way that they do is more of a way to get people to not pay attention to the dangerous thing, that if they only knew what they were actually doing, people might revolt. I think sometimes we're seeing leadership using those manipulations to keep people at peace, more so than is it true? Is it the true economic reality of what's happening? When the government sees that hyperinflation is starting to occur, the first thing they do is not to announce it to everybody that it's occurring, because it makes it 10 times worse if everybody goes to try to pull their money out of fractional reserve institutions. So cause and effect, once again, I find interesting, because if you can understand the reason that certain things are happening in society, sometimes you can come up with better ways to manage those things. And I think that that's a lot of why looking at thought leaders, coming from the perspective of somebody like Michael Saylor, are doing those things that they think are the right things to do for their business and for their livelihood, for their well-being. Now, it is a huge gamble. The idea of converting your dollars into Bitcoin for your publicly traded company means that Bitcoin needs to not fail. And The next thing that makes the blockchain not work, that none of us ever knew was a problem with blockchain, could be right around the corner, and none of us know it. But that's why longevity matters so much. Bitcoin and Litecoin both have been essentially going to prove the same models and whether they work or not. And Bitcoin's been doing it for 12 years now. That seems like a pretty good bet compared to something that crept along 3 months ago that says, we're the new Bitcoin, we fixed all the problems that could be there. That may or may not be true, but in a shorter term, I think that you do need to have things like knowing exactly who is behind a project and how good they are at what they do, and what is their philosophy behind what they're doing, what are their political motivations behind what looks like success to them. Just like somebody in car manufacturing, like Elon Musk, I care much more about his motivations behind Tesla than I do about whether the car works. Because we're dealing with the technology of a car line that intends to, it's not just a disruptive technology, it's a complete annihilation of the old way of doing things. And there might be some of those things that we miss if they're done away with improperly or hastily, or under the wrong pretense. Cause and effect. Very, very important. So how do these things come in contact with crypto? Obviously, if it deals with money, it deals with crypto, and vice versa. Inflation can make it to where it is very difficult to save, but it also has this additional, I would say, exponential pressure that it places on what you have already accomplished, meaning that if you're getting a paycheck every 2 weeks and you're having trouble paying your bills and the cost of certain items continue to go up, you start looking at what kind of sacrifices can I make just to keep the wheels turning. Do I need to do more work? Do I need a side gig? Am I already doing my side gig just to try to earn a living? Do I need to change the things that I'm buying? Have I already made that adjustment? All these different types of things. Most people who are diehard and believe, especially Bitcoin, but really anything in the crypto area that you have done your research and you think is that thing, most people believe that the worse that conditions get, the more aggressive you should be in saving towards whatever those assets are you think will survive this kind of mess. The next thing that I think is very important in thinking of how you save and what you're saving towards is, are things going to improve? Are the governments doing something that is a fail-safe or that they're trying to get us out of a mess? I would say more and more people's instinct are telling them that these problems that we're facing are planned, that they're intentional, that they are steering us towards a future that is intentional. And by the way, Bitcoin just hit 50,000 on the nose, so it finally broke through. Hallelujah. 10:40 p.m. Eastern Standard Time on the 22nd of August 2021. 50K again. Nice. So that was fun. So invigorating. So if we take Gordon's brilliant black hole analogy, metaphor, symbol, example, and apply it to cryptocurrency, we're looking at inflation as being something that basically devalues everything that we need money for, because we still hold money as a standard that cannot be changed. A 1 equals 1 no matter what. So everything else either fluctuates up or down based on its value. So if we're looking at the black hole example as evidence that something is changing in the value of things, meaning that printing too much money and other factors that surround that decision are making the value of the money go down, then what can we do to counteract that somehow? So specific to cryptocurrencies, as I've been mentioning, my suggestion is not to just go looking for the massive pumps. Don't go chasing 5% here, 20% there, 2% here, 300% there, because everybody who does this is playing a game of guesswork. And even if you're good at charts, even if you trust your sources about certain information, you're going to make one of those decisions wrong. And if something you were expecting to do 150% up doesn't do the thing you were expecting, you're going to be somewhere up there very high compared to what its actual value is. And when it comes back down, there's a very good chance it never goes back up there again. In cryptocurrency especially, a pump and dump is literally the only thing that thousands of these assets have to benefit. People who operate pump and dumps have already got their money and positions in place, and they have carefully orchestrated their model for when and where to sell, and nobody else is guaranteed to make the profit that they are going to make. So another thing being that really and truly, there's nobody on planet Earth that can tell you what the really safe assets are. There's risks to silver and gold and precious gems just as much as there is in tech stocks, as much as there is in car manufacturing. There's lots of things that we become reliant upon. We have expectations that we've placed on different asset classes, on consumables, on commodities. But there are no guarantees, and so everything is a risk. So to reduce risk, one of the things that you look for is longevity, reliability. And some people, there are different groups of thought on this, but market cap is something you can look at where if there's already a certain amount of traction on a coin, let's say something like Dogecoin, for example, where it gets diluted, and maybe they're going to change that aspect of Doge to make it more usable as a fun money meme thing that means something to somebody somewhere. There's a huge crowd of people that will probably continue to be interested in Doge and put money in and out of it. But the lesson to have been learned by Doge is going to $1, no, it's not. I think that people are going to keep getting burned by that same kind of thing. And it does not make it a good investment for anybody. Doesn't mean that you can't have fun placing some of your bets in that if you're a gambling person, or there's nothing wrong with owning some Doge at different prices if you want the experience of actually being able to spend Doge on something. That's fine. Just, if you buy a ticket to a movie, you've also spent money that you can't get back. So if it's an entertainment value thing, then that's cool. You're virtue signaling your favorite coin type thing. But we're talking about investments and serious grown-up stuff about surviving the risk of inflation. And in this case, reducing risk means looking for the coins that have sustained the most blows, that have maintained a market cap that doesn't just pop way up and then drop way down and only fluctuates when there's a lot of attention on it. But we're looking at things that have massive 24-hour volume all the time. And in crypto, massive can mean literally just always tens of millions. It may not be hundreds of millions. It may not be hundreds of billions of dollars always happening, So clearly Bitcoin is the longest running coin. It's reached the highest value. It has probably the best economic design engineered in. And then there's Litecoin and Ethereum. Now, there's a lot of warring in the two camps between Ethereum and Bitcoin, and there's valid things to be said on both sides. I think the risks are heavier against Ethereum than they are against Bitcoin. But then there are lots of other legitimate projects that are interesting to research and discover. But the big question mark comes there from whether they're providing you a utility that will be a benefit to people that comes out of crypto, or whether these are going to be able to survive kind of like a startup needs to survive the ridiculous heavy-handed government regulation and intervention. I think some of those projects will survive, but I think that they're not necessarily placed to take your risks for the future. So really it comes down to those three. So when I talk about Bitcoin, I am talking about cryptocurrency at large, but you can place into that whatever you would consider your research skills, your good decision making of what you think is going to do well over time. So then it comes to, if you're looking at what price entry you're making your purchases into something like Bitcoin, how does that help you to hedge against inflation? The first point would just be the most logical point, being that over 12 years, it has done nothing but perform in the right direction. So the earlier that you made the decision to get into Bitcoin, the more you are looking at massive profits. Over time, there's only so much that something can double or triple. There's a finite amount of resources in the world. Just alone, if you look at the number of people and the amount of money that each person is able to earn averaged out. So we could see $1 million Bitcoin. We could even see $1 billion Bitcoin. We're not going to see $1 trillion Bitcoin, in my opinion, unless hyperinflation has gotten to such the point that there's literally like a few thousand people in the world that can afford to buy bread. So, you get outside of the bounds of logic once you reach a certain point. But inflation, as it pertains to crypto, basically you're trying to say, how far outside of that edge of the pull of gravity can I stay? Almost like a rubber band effect. How far can I push against the other end of the rubber band to stay away from this thing that is pulling me towards it? And that infamous vacuum of the universe in a black hole is trying to pull the value out of everything. And that's what bad decisions being made will do. It is a free enterprise capitalist mentality decision that a person is making in order to try to store up value against the terrible things that inflation is doing. And I believe that some of the analysis that people like Michael Saylor have done is accurate to say that when you factor in the GPI, when you factor in the GDP, when you factor in which stocks are going up by what value, and when you factor in how much buying back is the government having to do, what is happening with the bonds, and the moving out of money markets into stable coins, all of these things are adding up to a real start of hyperinflation. I think that we're more in the 20 to 27%, not in the 5% that they're admitting to. I think that the crushing devaluation is happening already. And it's not just early signs that we see like in logical things like lumber or things that there becomes a crunch of supply demand and you need them desperately. I think that we're looking at real long-term change, and unless the regimes change and we get back to some kind of logic to leadership, which doesn't seem like it's going to happen, but unless that changes, then we're going to see much more than the regular 7% a year devaluing of the dollar. And that dollar impacts everything else that essentially is looking to pair with it. So you want to be able to be in an asset that if you're doing well enough to where all you need to do is stabilize back to zero, then you need to have your money in basically what I would say is 7% plus whatever your cap gains percentage is, because you will either need to draw on that somehow or you'll need an interest rate to borrow against it somehow. So for instance, you could buy one Bitcoin. Let's say you bought one Bitcoin at $20,000 and you've watched it go up to 50. If you are just holding that Bitcoin over time, then you don't owe any cap gains on it. At the same time, you haven't actually done anything to lock in the value of it having gone up. So one of the things that people can look at is if interest is low to no interest on something, you could do a loan. Let's say when it hit $30,000, you could borrow $30,000 against your Bitcoin, and you could use that as your buying power at that amount. Now, you could actually look at the benefits of the Bitcoin going up more and drawing more from that. You could even pay it off early. Maybe you could even pay without paying the interest. There's a lot of clever things that you can do with the value of money just by holding on to the asset. Somebody else might look at this from the approach that they want to trade, once or twice a week, try to grab when Bitcoin goes low and sell it when it goes high. And a lot of people will say, why would you want to sell the superior asset into the inferior asset? And I have a good answer for that. That would be that if you don't have hundreds of millions of dollars like those who are probably doing the right thing long-term with their assets, trading is the only way that a person is going to be able to accumulate more Bitcoin. for somebody, let's say that they have a few $1,000s that they can invest in something. Well, they're going to most likely ask around to everybody, what's the most likely cryptocurrency to go up 200%, 300%? Because they think that they have to latch onto something that's going to go crazy to the moon, and they can sell it and make their fortune, and then they're fine because they only had a few $1,000s, so they have to guess this crazy thing correctly. I would say that the more logical decision would be to watch for the smaller, more difficult, challenging fluctuations in a more trustworthy asset and buy the dip. And the question there is, if you have an inflow of money that you can afford to invest in something, then every time there is a dip, you should buy it. If you only have a finite amount of funds, then you wait for a dip, you buy some, you wait for that to go up a certain amount, and you sell it, and you keep track of what your percentage of earnings is going to be paid back out in taxes. So if you had a few $1,000s and you were to set a standard for yourself of every time Bitcoin goes down, let's say 3%, you want to buy 10% of your money that you have available, you want to buy Bitcoin, and wait until that goes up, let's say 2%, and sell it at a 2% profit. So you're always watching for a range for Bitcoin to do. Well, I mean, the good news is that it pretty much always is doing that kind of range. The bad news is it's very difficult to stay within that range. So part of tuning your risk reward is to decide on assets that, if you're wrong, are not going to just bury you and never come back again. The other part of that being that if you think that you can guess a percentage range by the wild fluctuations that everybody's always talking about, trust me, it's just as easy to be wrong as it is to be right. So it's got to be something that is within a window of guesswork that you can repeat over and over. But let's say that in the time of 300 days out of the year that you want to get in and out of a Bitcoin move 1 out of every 3 of those days, and you're looking to get 1 or 2% of that. Okay, well, if you succeed in doing that 100 times over the year, then you will have doubled whatever that part of your investment is. And hopefully, if you're in a fairly low earning range, then maybe you owe 10% on your capital gains. So you could conceivably get up by 80, 90% of something. But to counterbalance inflation, we're talking about needing to hit 7% of your entire earnings to stay where you need to stay. So you either need a more aggressive strategy, or you need to find the same subtle strategy, a way to do it more often. So the truth of the matter is that any way you look at it, everybody's got a very strong opinion, but you have to do the strategy that makes the most sense for yourself. And my advice is coming from having tested a lot of different things with a lot of trading skill. And I don't come from a place where I'm starting with millions of dollars and I just basically have to hold the best asset. I actually need this to be able to earn itself towards a sustainable goal. So I understand about buying the dip and selling the top for profit. And even if you held out for 5, 6, 7, 8, 9, 10% profit, how long did you have to wait for it to reliably do that? And how long do you wait for it to go down before you go in again? See, you're always playing a time versus reward game in this. And inflation, unfortunately, is our enemy. If it wasn't the reason that we were talking about this, then you could take all the time that you need. But it is weighing against all of us. It is wearing away our wealth. And in order to counteract that, we all have to take risks. And a lot of us are going to take the wrong ones and fail. And a lot of us are going to take the right ones and win. So this is an important topic and one that I have become passionate about. And I hope that my advice goes a long way to help you in your own decision making. This is not financial advice. Do your own research. But at the end of the game, I would much rather encourage people to stay away from pump and dump scams, from the hundreds, if not thousands of other coins that are out there, and get them to focus on the assets that bankers, institutions, governments, whales, and it now seems the banks themselves are all relying on to continue and succeed, which is Bitcoin, Litecoin, Ethereum. So I hope that this has been interesting. I hope that the logic and information of this has not been lost into a black hole. And I hope that you enjoyed this episode. Thank you so much for listening. And until next time, for now, Crypto Gordon Freeman out.